The moment people start demanding gold, the system stops being stable. It starts shrinking, fast, and on purpose. By the end of this documentary, you'll understand the trap hiding inside the gold standard. Not the myth, not the romance, the mechanism. How a promise meant to create trust can force contraction at the worst possible moment and turn fear into a self-feeding crisis. The gold standard is usually sold as discipline, money anchored to something real, governments restrained, prices steady. But stability is not what the system does under stress. Because when confidence cracks, the gold standard doesn't absorb the shock, it amplifies it. Because the gold standard is not just a backing, it is a commitment device. It's a promise that the money in your pocket can be converted into a fixed amount of gold, on demand, under rules that are supposed to be non-negotiable. And when a society treats that promise as sacred, the system starts to behave like a machine with only one setting. It can expand slowly, and it can contract violently. And that's where the trap begins. But here's what nobody tells you up front. The gold standard doesn't fail only when governments cheat. It can work as designed and still break a country. Under a gold standard, money is ultimately a claim on gold. Not metaphorically, operationally. Banks, businesses, and households treat the currency as redeemable. The state treats convertibility as a credibility pledge. And the central authority, whatever form it takes, treats its gold reserve as a boundary line it must not cross. So the system has a built-in constraint. You cannot create money freely when demand for money suddenly spikes. You can only create money if gold flows in, or if confidence stays so high that people don't ask for redemption. Now add the reality of stress. When uncertainty rises, people want safety, they want cash, they want something redeemable, they pull deposits, they convert, they hoard. That behavior is rational at the individual level, but it is lethal at the system level, because once the demand for gold rises, gold reserves start falling, and as reserves fall, the authorities face a choice. Option 1, protect the banking system and the economy with liquidity. Option 2, protect the peg. Under the gold standard, you are trained to pick the peg. So the usual response is to tighten, raise rates, restrict credit, cut spending, make money scarcer so that gold stops leaving. And that is the trap's feedback loop. Fear causes outflows. Outflows force tightening. Tightening deepens the downturn. The deeper downturn creates more fear, and the cycle repeats. And that's where the system quietly flips. A standard meant to guarantee trust starts manufacturing distrust. Because once people believe the authorities will sacrifice the economy to defend convertibility, they behave as if the economy will collapse. And then it does. If you want one sentence that captures the mechanism, it's this. A fixed promise makes the money supply pro-cyclical, tight when you need it loose, loose when you need it tight. And once that happens, the gold standard stops being a foundation. It becomes a lever that amplifies shocks. The gold standard sells itself as morality, a restraint, a limit that prevents irresponsibility. But a limit is not the same thing as a stabilizer. A stabilizer absorbs volatility. A rigid limit often converts volatility into breaks. Under gold, every institution learns the same lesson: conserve reserves. Banks learn it first. They keep gold or claims on gold. They keep liquid assets. They become cautious. In good times, caution looks like prudence. In bad times, caution becomes a stampede. Because banks don't just hold money, they create it. Credit is money-like. Deposits are money-like. And when banks pull back, money-like claims vanish. So the economy doesn't just slow down, it loses its circulating blood. But here's what nobody noticed at the time. Under gold, the safest behavior for each bank is to become less safe for the system. When one bank tightens, it protects itself. When all banks tighten, they destroy aggregate liquidity. And once liquidity vanishes, defaults rise, prices fall, collateral values drop, and banks tighten again. Because once X happens, Y becomes inevitable. Once prices start falling broadly, debt becomes heavier without any new borrowing. A borrower owes the same nominal amount, but earns less cash to repay it. That forces cutbacks. That forces layoffs. That forces more deflation. And the gold constraint means the authorities can't easily reverse it. So the first chapter ends with a simple inversion. The rule that was supposed to prevent instability makes instability harder to stop. A gold standard is often presented as technical, as if it's just math, a fixed weight, a fixed price, a fixed conversion. But it isn't technical first, it is political first. Because defending gold convertibility requires decisions that produce visible pain. Higher interest rates don't hurt everyone equally. Credit restriction doesn't hurt everyone equally. Cuts don't hurt everyone equally. And the promise becomes a hierarchy, whose pain counts as acceptable to preserve credibility. This is why the gold standard creates a particular kind of politics, a politics obsessed with confidence, not employment. A politics that treats domestic distress as the necessary price of external stability. And once the system is framed that way, the mechanism becomes self-reinforcing. If the authorities hesitate, markets interpret hesitation as weakness. Weakness triggers more outflows. More outflows force harsher tightening. Harsher tightening deepens the downturn. And now the promise is no longer a promise to the public. It is a promise to external holders of claims. Foreigners, creditors, financial centers. But here's what nobody noticed. A country can be credible and still be ruined. Because credibility under gold is often measured by the willingness to contract. If the public believes the authorities will always defend convertibility, they might keep holding the currency. But the cost of maintaining that belief can be mass unemployment, business failures, and collapsing tax revenues. And then the state itself weakens. So you get a second inversion. Defending the gold pledge can undermine the fiscal and political capacity required to keep any pledge at all, and that's where the system quietly flips again. The stronger your commitment, the more brittle your society becomes. Supporters of the gold standard often describe an elegant self-correction. If a country runs a deficit, gold leaves. As gold leaves, money tightens. Prices fall. Exports become cheaper. Imports become expensive. Balance returns. It sounds automatic. But in real life, the adjustment is not a smooth slide. It's a forced fall. Prices don't fall evenly. Wages don't fall easily. Debts don't fall at all. So the correction mechanism demands something specific: internal deflation. Not a minor adjustment. A sustained squeezing of incomes and prices until the country becomes competitive again. And that is politically and socially explosive. Because you are asking the entire economy to accept less cash income to satisfy an external accounting identity. And when the system is under stress, the demand for deflation collides with the demand for survival. So the adjustment stops being automatic. It becomes a conflict. Workers resist wage cuts. Businesses resist price cuts. Banks resist writing down assets. Government resists unemployment. But the gold constraint doesn't negotiate. It punishes. If you don't deflate, reserves keep draining. If reserves drain, the peg becomes vulnerable. If the peg becomes vulnerable, a run becomes rational. But here's what nobody tells you. Even if wages do fall, the debt burden rises in real terms. So the adjustment can succeed on the ledger and still destroy the credit system. Because once X happens, Y becomes inevitable. Once defaults begin in a deflationary environment, asset prices fall further, collateral breaks, and lending collapses. That's a third inversion. The self-correcting mechanism corrects by breaking things. Even where a central bank exists, gold compresses its mandate. In a modern imagination, a central bank can act as lender of last resort. It can flood the system with liquidity to stop a panic. It can cut rates. It can stabilize. Under a strict gold regime, that flexibility is constrained by reserves and by the fear of redemption. So in a panic, the central authority faces a cruel dilemma. If it provides liquidity, it may stop bank failures. But it may also accelerate gold outflows if people use newly available money to convert into gold. If it defends gold by tightening, it may slow outflows. But it worsens the panic, increases failures, and reduces confidence. Both paths carry risks. But the gold standard rewards one path socially and politically: defend the peg. And so the institution becomes a machine aimed at one outcome: preserve convertibility. If you want to understand why the gold standard is a trap, focus on that. Because once the public believes the institution's priority is the peg, private actors front-run the institution. They hoard, they convert early, they cut lending, they demand collateral, they reduce exposure. And now the mechanism is fully activated. The system begins to behave as if disaster is inevitable. And that's where the system quietly flips. Again. A standard designed to stabilize expectations destabilizes behavior. At this point, it helps to ask a question that sounds simple, but changes everything. What is stability supposed to mean? Stable prices, stable exchange rates, stable employment, stable banking? The gold standard often delivers one kind of stability by sacrificing the others. And the sacrifice is not abstract. It's a transfer. It transfers the burden of adjustment away from creditors and onto debtors, away from financial claims and onto real incomes, away from balance sheets and onto bodies. If you want to subscribe for more documentaries like this, calm, factual, mechanism first, do it now, because the next episodes build on the same invisible machinery. There is a moment in every gold standard crisis when the logic becomes undeniable. It's when the public stops asking, is the peg defensible? And starts asking, is the peg worth defending? That question is fatal to the regime, because the gold standard is not just economics. It is legitimacy. If the regime is seen as sacrificing society for a promise to redeem metal, the social contract frays. If the social contract frays, confidence falls. If confidence falls, outflows accelerate. But here's what nobody admits. The gold standard is a coordination game. It works if everyone believes it will work. And it fails once enough people believe others won't accept the pain. In that sense, it is not a natural law. It is a fragile agreement. And once it becomes fragile, the authorities are trapped by their own credibility story. If they loosen policy to reduce pain, they signal weakness to defenders of gold. If they tighten to defend gold, they confirm the public's fear that the system is indifferent to suffering. Either way, trust breaks. And that's when countries begin to do the thing the gold standard was designed to prevent. Change the rules. Not always because they want to inflate. Sometimes because they want to survive. And that is the key to understanding the trap. The gold standard creates crises where the only way out is to violate the promise that defines the system. The turning point is not a single event. It is a phase change. It happens when the gold standard stops being a neutral anchor and becomes the central cause of contraction. In that phase, every attempt to defend the peg tightens the economy further. Every tightening increases political pressure. Every increase in political pressure raises doubts about the peg. So the authorities face a choice that is no longer about ideology. It is about which system they prefer to break. Do they break convertibility? Admit the promise cannot be maintained under stress? Or do they break the domestic economy, accept prolonged deflation and unemployment as the price of the pledge? This is why the gold standard is a trap, because it frames the choice as morality versus irresponsibility when the real choice is between two kinds of failure. And the more orthodox the defense, the more dramatic the eventual rupture. If you have ever wondered why gold standard episodes often end with abrupt shifts rather than gentle transitions, that is why. A rigid regime doesn't bend. It holds until it snaps. When a gold standard breaks, the immediate consequence is not always chaos. Often, the immediate consequence is policy space. Suddenly, authorities can expand liquidity without watching reserves tick down like a doomsday clock. They can focus on domestic stabilization rather than external conversion. But that doesn't mean the story ends with a simple victory, because leaving gold changes the incentives. Creditors worry about devaluation. Savers worry about purchasing power. International partners worry about exchange rate shifts. Governments face temptation. And the next regime, whatever replaces gold, creates its own traps. But we should be precise about what changed. Under gold, the primary constraint is physical and psychological, reserves and redemption fear. Once gold is removed, the constraint becomes institutional, credibility of policy, fiscal discipline, monetary governance. In other words, the world doesn't become rule-free. The rules change. And that shift redistributes power. Those who benefited from deflationary discipline lose leverage. Those who suffered under forced contraction gain relief. The state regains room to act as backstop. But there is a deeper consequence that matters for our series. The gold standard teaches institutions a habit: treat money as a scarce commodity rather than as a policy instrument. That habit can outlive gold itself. You can leave gold and still run a deflationary system. You can abandon convertibility and still prioritize confidence over employment. You can change the backing and keep the same political logic. So the trap is not only about metal, it is about the ideology of rigidity. And that ideology can migrate. If you want to comment, keep it investigative. When you hear sound money, do you think it means stable living standards or stable creditor claims? And when a society chooses discipline, who exactly is being disciplined? So was the gold standard stable? It could be stable in one narrow sense. It reduced discretion. It made exchange rates predictable. It restricted monetary expansion. But stability is not the absence of discretion. Stability is the capacity to absorb shocks without destroying the real economy. And that is where gold fails, not because people are irrational, but because they are rational. In good times, redeemability builds trust. In bad times, redeemability becomes a weapon against the issuer. In good times, the peg is a symbol of strength. In bad times, the peg is a constraint that forces contraction. The hidden mechanism is simple. A rigid promise makes money supply respond to fear in the wrong direction. Fear should call forth liquidity. Under gold, fear drains liquidity. And once that happens, the system becomes pro-cyclical by design. That is why the gold standard is not merely a backing. It is a crisis amplifier. It turns banking into a hoarding contest. It turns central banking into a peg defense operation. It turns political legitimacy into an endurance test of pain. And that is what makes it a trap. Not that it never works, but that when it matters most, when a society needs flexibility, it demands rigidity. And once you see this mechanism here, you'll start seeing it everywhere. In systems that promise fixed convertibility, fixed pegs, fixed parity, fixed guarantees, without a reliable backstop. In the next episode, we'll follow what replaces the gold promise. Not with nostalgia and not with cynicism, but with the same question we use today. When stress arrives, does the system create money to stop the fire, or does it pull money away and let the fire spread? Because once you understand that choice, you understand how empires don't just rise. They finance their rise, and sometimes they finance their fall.